inflation cooled in July, but prices are still rising for many.
How well the temporary foreign worker program is working and how our overall...
Canada has always prided itself on stability, a country of polite politics, steady banking, and promises of opportunity. But beneath the surface, that stability is eroding. In July, the news cycle gave Canadians what looked like good news. Headline inflation had cooled. For the first time in months, the official numbers showed a slowdown. Gasoline prices fell sharply, dragging the index down to 1.7%. On paper, it was relief, a victory headline. But for the families standing at the checkout aisle, it felt like a cruel joke. Groceries were still climbing, up 3.4%. Shelter costs had reversed their decline, rising 3%. The everyday bills of life, food, rent, insurance, utilities kept pressing higher. Benjamin Tal, Deputy Chief Economist at CIBC, cut through the numbers with a blunt warning.
We are in a per-capita recession. Inflation is close enough to 2%. It's time to cut.
It's time to cut. They should have cut before. But I think February is now very reasonable. His message was clear. The economy was weaker than it looked. Behind the averages and statistics, ordinary Canadians were slipping. Canada has always prided itself on stability. A country of polite politics, steady banking, and promises of opportunity. But beneath the surface, that stability is eroding. In July, the news cycle gave Canadians what looked like good news. Headline inflation had cooled. For the first time in months, the official numbers showed a slowdown. Gasoline prices fell sharply, dragging the index down to 1.7%. On paper, it was relief, a victory headline. But for the families standing at the checkout aisle, it felt like a cruel joke. Groceries were still climbing, up 3.4%. Shelter costs had reversed their decline, rising 3%. The everyday bills of life, food, rent, insurance, utilities kept pressing higher. Benjamin Tal, Deputy Chief Economist at CIBC, cut through the numbers with a blunt warning. We are in a per capita recession. Inflation is close enough to 2%. It's time to cut. They should have cut before. But I think February is now very reasonable. His message was clear. The economy was weaker than it looked. Behind the averages and statistics, ordinary Canadians were slipping. At the same time, a new shockwave hit small businesses. The Canadian Federation of Independent Business sounded the alarm. Tariffs were crushing firms already stretched thin. Steel and aluminum had been targeted. The $800 duty-free exemption for imports from the US was gone. Suddenly, even small retailers faced a wall of costs. 1 in 5 businesses, the CFIB said, might not survive another 6 months if nothing changed. Ontario Finance Minister Peter Bethlen-Falvey put the crisis into human terms. The steel industry, the aluminum industry 50% tariffs, the auto sector 25%. For companies hit square on, it's been a challenge. That's why we've put another $1 billion into a fund to support businesses, billions in provincial lifelines, billions in federal deferrals, billions more promised in retraining. Yet the question lingered, was Canada pouring water into a sinking ship? Because behind the tariffs was not simply an economic debate. It was a political weapon. Benjamin Tal again. When people say it's not about the money, it's always about the money. Tariffs are about raising money. A 10 to 15% tariff globally gives them $320 billion to spend. That was the reality. Tariffs weren't about protecting American workers or rebuilding factories or reviving forgotten towns. They were about revenue, a giant tax disguised as nationalism. And for Canada, that meant the rules of the game could change overnight. Canada's economy has always been tethered to the United States. The world's longest undefended border is also the world's most integrated economic lifeline. Trade, investment, supply chains, every Canadian dollar is shadowed by American policy. So when Bloomberg anchors in New York raised a chilling phrase, yield curve control, it wasn't just about Wall Street. It was about mortgages in Toronto, grocery bills in Vancouver, jobs in Montreal. On US Bloomberg, Jonathan Farrow laid out the danger. The White House wants lower rates at the short end. But lower short rates could mean higher long-term rates, exactly the opposite of what they want for mortgages. In other words, the president might get his wish for cheaper short-term credit. But the bond market could revolt, driving up the very long-term rates that dictate Canadian mortgages. And if that happened, Canadians would feel the squeeze instantly. To understand why, Bloomberg broke it down in simple terms. Bond prices and yields move in opposite directions. If investors expect higher inflation, they demand higher yields. No matter what the Federal Reserve does with overnight rates, long-term rates belong to the market. That's why, even after the Fed cut by 100 basis points since September, the yield on the 10-year Treasury had risen by 60 basis points. Mortgage rates were climbing, not falling. And that was before yield curve control entered the debate. Yield curve control is not just another policy tool. It is a declaration of power. Unlike quantitative easing, where central banks set a fixed schedule of bond purchases, yield curve control is limitless. If the U.S. government decides the 10-year Treasury should yield 2%, the Federal Reserve will print however much money it takes to buy however many bonds it needs until the yield obeys. Bloomberg's explanation was stark. They'll print as much money as they need to buy as many bonds as it takes. For Canadians, the consequences are massive. During the pandemic, quantitative easing pushed the average 5-year fixed mortgage to 2.12%. Banks were flooded with liquidity. Households rushed to lock in cheap debt. Housing markets overheated. If yield curve control is unleashed, it could again force Canadian mortgage rates down, not because of anything the Bank of Canada does, but because Canada's bond yields track America's almost step for step. A money printer in Washington could mean cheaper mortgages in Toronto. But it could also mean higher inflation, a weaker currency, and new distortions across Canada's fragile economy. The irony is cruel. Ottawa debates austerity while Washington debates printing trillions. Back home, the federal government announced it would slash $13 billion in spending by 2029. 10% reductions in departmental budgets next year, 15% the year after. The target? 57,000 public service jobs gone. Economist John Lester, fellow at the C.D. Howe Institute, warned against the axe-first approach. If it were up to me, I'd take a broader approach. Not exempt so much spending. Select programs after careful review. Otherwise, you're trading efficiency for speed. But speed is what Ottawa wants. Cuts now, analysis later. Even as the government pumps billions into defense, billions into housing subsidies, billions into industrial policy, it's austerity and stimulus at the same time. And amid this schizophrenic budget stance, the fundamental structure of Canada's economy remains unchanged. Jim Stanford, director at the Centre for Future Work, explained the problem. We dig it out of the ground and sell it, then buy back expensive products made elsewhere. If we want sovereignty, we need to do more of that work ourselves. That's where the value add is Canada exports raw minerals and lumber, then imports finished technology. It fuels the global supply chain, but captures only the crumbs of value. And now, with Trump threatening sector-by-sector tariffs, the vulnerability is clear. Stanford again. Critical minerals are a great example. We have them, but we shouldn't just dig them out and sell them. We should process them, upgrade them, and manufacture them here. That's how we stand on our own feet. But while policy papers debate sovereignty, ordinary Canadians are drowning in debt. For homeowners, the debate about tariffs and fiscal policy means nothing compared to a renewal letter in the mailbox. Ron Butler, mortgage broker, described the reality. We have an incredibly slow real estate sales environment. New construction in Ontario and BC has cratered lowest in decades. Renewals? Disappointment everywhere. Fixed rates aren't falling. Variable rates aren't falling. There's disappointment everywhere. The Bank of Canada held at 2.75%. It was expected. It was shrugged off by markets. But for households, it was devastating. No relief, no breathing room. Butler didn't sugarcoat it. It was totally expected. No effect on the market. People were hoping for relief. They didn't get it. The result? Families cut back on spending, developers shelve projects, confidence evaporates, and the so-called Canadian dream, a home, a steady job, a safe future, slips further away. Into this storm stepped Pierre Poilievre, Conservative leader. His message was explosive: scrap the temporary foreign worker program, end it completely. Canadian jobs for Canadian workers, Canada first, Canada always, Poilievre thundered. He cited staggering numbers: youth unemployment at 14.6%, the highest in decades outside the pandemic. 1.66 million Canadians unemployed in July. Nearly 400,000 searching for work for more than 2 years, the highest long-term unemployment since 1998. Temporary foreign workers now 2% of the workforce. Tim Hortons hiring 1,131% more TFWs in 4 years. It's not the workers. They're not bad people, Poilievre insisted. They are being exploited by elites who want to drive down wages. Canadian jobs must go to Canadian workers first. His call was radical: scrap the program outright, no new visas, wind down existing permits, shut it all off. It was a political earthquake. As Pierre Poilievre raised the stakes, accusing Liberals of betraying Canadian workers, Prime Minister Mark Carney responded with the tone of a banker-turned-statesman. Where Poilievre thundered, Carney recalibrated. We want immigration levels as a share of the population to decline from about 7% today to around 5% in the coming years, Carney said. But businesses, especially in Quebec, tell me that after tariffs, their number 2 issue is access to temporary foreign workers. It was a careful balancing act. On the one hand, acknowledging public anger over youth unemployment and the scale of TFW permits. On the other, protecting industries that insisted they would collapse without access to lower-wage labor. Carney did not deny the flaws of the program, but he framed it as a question of national productivity, not betrayal. This program has a role, he said. We can improve it. We can refine it. But we cannot ignore the demands of businesses. CTV's cameras captured a rare moment of transparency. Carney's cabinet, assembled in Toronto just 12 days before Parliament's fall sitting. It was a scene designed for television. Ministers arriving in black sedans, aides clutching briefing binders, journalists circling like hawks. Carney revealed he had spoken to Donald Trump just days earlier. A high-stakes call, unplanned but necessary. The topics were brutal and familiar: steel, aluminum, copper, autos. Punishing tariffs that squeezed Canadian exporters and rattled investors. I last spoke to the president Monday evening, Carney told reporters. We spoke at length. Behind closed doors, ministers were briefed on the fallout. Canada's pollsters had warned tariffs were no longer the top fear among voters. The cost of living, job creation, and housing dominated. The challenge was stark. Tariffs were hurting industry, but voters were hurting at home. Carney's proposed solution was paradoxical: an austerity and investment budget, cuts to the public service, new billions for housing, defense, and industrial projects, restraint and expansion side by side. CTV's Kapelos put it plainly. The Prime Minister called it an austerity and investment budget. But where exactly will the cuts come from? They haven't said. They promise to spend on defense. They promise to spend on programs. But they won't reveal what gets slashed. Meanwhile, Poilievre doubled down. Speaking in the Greater Toronto Area, he declared, "Corporations aren't hiring unemployed Canadians because they can pay temporary foreign workers less. It's that simple. Canadian jobs for Canadian workers." His words were cheered by some, but not all. Farmers warned that without migrant labor, crops would rot. Small businesses insisted that locals wouldn't take the jobs. A farmer told CTV, "I don't know how you do away with the temporary foreign worker program in totality without harming agriculture." Advocates for migrants added their own voice. These are not summer youth jobs. Linking youth unemployment to TFWs is bizarre. Ending the program would shut down small businesses in rural communities. The debate became a battle of absolutes. Scrap it all versus reform it carefully. And as politicians sparred, the numbers told a darker truth. 1.66 million Canadians unemployed. Nearly 400,000 searching for work for 2 years or more. The highest long-term unemployment since 1998. In French, Carney described the looming budget. This budget is about fairness for every generation. But behind the rhetoric, questions multiplied. Federal spending had grown by 7% annually for more than a decade, double the pace of the economy itself. Economists warned it was unsustainable. Cuts were inevitable. Yet the government also promised to fast-track housing projects on federal land, pour billions into defense, and launch industrial megaprojects. Carney's budget would be both scalpel and hammer, both restraint and expansion. To guide ministers, the government even invited an American analyst linked to Project 2025, the right-wing blueprint shaping Trump's next campaign, a move that stunned observers. Canada's Liberals quietly learning from Trump's allies. The media portrayed the clash as two visions of Canada. Poilievre's vision: end the exploitation, shut down TFWs, protect Canadian jobs. Carney's vision: reduce immigration gradually, preserve TFWs for industries, manage austerity with investment. Neither side offered an easy solution. Both played to different audiences. Poilievre to the unemployed and angry, Carney to businesses and moderates. But for Canadians at the grocery store, or the mortgage desk, or the factory floor, the clash was background noise. What mattered was whether the next bill could be paid. By late summer, Canada felt like a nation of contradictions. Inflation was cooling, yet life was more expensive. The Bank of Canada paused, yet mortgages were suffocating households. Ottawa promised cuts, yet also billions in new spending. Conservatives demanded jobs for Canadians, yet businesses pleaded for foreign labor. It was as if the country stood in two realities at once. CTV's Rachel Aiello summed it up. The Conservatives want the TFW program scrapped. Carney says it still has a role. Poilievre insists businesses don't need it, they just want cheaper labor. Carney says businesses across Quebec and elsewhere tell him they do. Critics warn ending it would cripple small businesses. Every quote contradicted the next. Every fact was doubled. This was not the first time Canada faced such contradictions. In the 1930s, tariffs had triggered recession and retaliation. In the 1980s, austerity collided with unemployment. In the 2008 crisis, bailouts saved banks but left workers adrift. The patterns repeated. Governments promised stability, but the shocks always came from beyond Canada's borders. Benjamin Tal's warning echoed like a prophecy. This is not the end. This is just the beginning. Behind the statistics were human lives. The student juggling part-time jobs at minimum wage, watching their rent climb. The family in Ontario whose new home construction was suddenly cancelled. The long-term unemployed in Alberta, sending out resumes for 2 years with no reply. And the migrants men and women flown in to pick fruit, clean hotels, serve coffee. Exploited by corporations, resented by locals, yet blamed for policies they did not design. Poilievre's voice rose in Parliament. The workers themselves are not the problem. They are being taken advantage of by liberal elites who use them to drive down wages. Carney's voice countered, businesses say access to temporary foreign workers is their number 2 issue after tariffs. We can improve the program, but it has a role. 2 voices, 2 visions, neither resolving the pain of those caught in between. What tied it all together was sovereignty. Could Canada truly control its destiny? If the Fed in Washington unleashed yield curve control, Canada's mortgage rates would fall not because of Ottawa, but because of American money printing. If Trump escalated tariffs, Canadian industries would suffer regardless of Canada's own policies. If Ottawa slashed spending, services would shrink, but inflation and bond yields would still be set abroad. Jim Stanford's words came back. We dig it out of the ground and sell it. Then we buy it back as expensive products. If we want sovereignty, we must capture the value here. Without that shift, Canada remained trapped, rich in resources, poor in independence. By the end of summer, Canadians were left with a story still unresolved. Inflation cooling, yet families poorer. Mortgages paused, yet dreams deferred. Austerity promised, yet billions pledged. Political battles raging, yet no clarity. And looming over it all, Washington's bond market, Trump's tariffs, global forces far beyond Ottawa's reach. This was Act 1 of Canada's unfolding crisis. The next acts would decide whether the country could navigate the storm or be swept away by it. Canada entered autumn with headlines pulling in opposite directions. One week, inflation cools. The next, unemployment spikes. One day, federal government promises cuts. The next, billions pledged for defense and housing. For ordinary Canadians, the whiplash was exhausting. For economists, it was terrifying. Benjamin Tal had already warned, "We are in a per capita recession. This is just the beginning." And behind his words was a darker truth. The uncertainty was not just Canadian. It was global. Every Canadian knows instinctively that when America sneezes, Canada catches a cold. But what few realized was just how tightly the two countries' financial veins were tied. On US Bloomberg, the phrase yield curve control kept echoing. Anchors debated whether the Federal Reserve, under Trump's pressure, might print unlimited dollars to force long-term rates down. Jonathan Ferro made it clear, the White House wants lower short-term rates, but lower shorts could mean higher longs. Exactly the opposite of what they want for mortgages. It was a paradox. Trump demanded cheaper borrowing to fuel growth, but the market might rebel, sending long-term rates up, not down. To stop that, the Fed might unleash yield curve control printing money until yields bent to its will. And if that happened, Canadian mortgages would follow. It meant a Canadian family's housing costs might soon be decided not in Ottawa, not at the Bank of Canada, but in Washington, at the desk of a US central banker. While Washington debated printing trillions, Ottawa debated cutting billions. The federal government's target, $13 billion in spending cuts by 2029. Departments were told, cut 10% next year, 15% the year after. The axe would fall on as many as 57,000 public service jobs. Economist John Lester saw danger. If it were up to me, I'd take a broader approach. Select programs carefully. Don't just exempt so much and swing the axe, otherwise you trade efficiency for speed. But Ottawa chose speed, cuts now, reviews later. Yet at the same time, Ottawa promised billions more for defense, billions for housing, billions for industry. In French, Carney defended the paradox. This budget is about fairness for every generation. The message was meant to sound balanced, but to many, it sounded schizophrenic. Meanwhile, mortgage broker Ron Butler described what Canadians already knew in their bones. We have an incredibly slow real estate sales environment. New construction has cratered lowest in decades. Renewals? Disappointment everywhere. Fixed rates aren't falling. Variable rates aren't falling. There's disappointment everywhere. The Bank of Canada's pause at 2.75% was no relief. It was a freeze. Families felt trapped, unable to move, unable to refinance, unable to breathe. The dream of homeownership, once Canada's great middle-class promise, was fading. Into this misery stepped Pierre Poilievre with a firebrand certainty. He accused Liberals of betrayal. Canadian jobs for Canadian workers. Canada first. Canada always. Scrap the temporary foreign worker program. He cited statistics that hit like a hammer: youth unemployment at 14.6%, 1.66 million Canadians unemployed, 400,000 job seekers stuck for over 2 years, the highest since 1998. Tim Hortons hiring 1,131% more TFWs in 4 years. TFW permits breaking records 200,000 in 1 year. Poilievre's verdict: it's not the workers. They're not bad people. They're exploited by elites to drive down wages. End the program. Canadian jobs for Canadians. The call was radical. Total elimination of the program. And it electrified his base. Carney, by contrast, offered technocratic caution. We want immigration levels to decline from 7% to 5% of the population. But businesses, especially in Quebec, tell me their number 2 issue after tariffs is access to temporary foreign workers. This program has a role. It was less a rebuttal than a reminder. The economy is not built on absolutes. Carney insisted reform, not abolition, was the answer. That Canada could improve oversight, close loopholes, and reduce dependence without shutting off the flow entirely. It was a message for Bay Street, for chambers of commerce, for industries who whispered they could not survive without migrant labor. The confrontation crystallized into 2 visions of Canada's future. Poilievre's Canada, protectionist, nationalist, focused on Canadian workers first. Carney's Canada, globalized, cautious, focused on balance and business needs. CTV's Rachel Aiello caught the contrast. Conservatives say businesses don't need TFWs, they just want to pay less. Carney says businesses insist they do. Critics warn ending the program would cripple farms and small businesses. The debate has no easy resolution. It was a portrait of paralysis. 2 sides locked in combat, neither offering a solution that comforted the unemployed youth or the struggling small town. This was not new. Canada had faced versions of this debate before. In the 1930s, tariffs devastated Canadian exports. In the 1980s, austerity gutted programs while unemployment soared. In 2008, bailouts saved the system but left workers behind. The details changed. The pattern did not. Canada remained a country rich in resources, vulnerable to global storms, and torn between protecting its own and feeding global markets. Economist Jim Stanford framed the deeper question. We dig it out of the ground and sell it. Then we buy it back as expensive products. If we want sovereignty, we must capture the value here. The TFW debate was just one branch of the tree. The trunk was sovereignty itself. Could Canada decide its own future? Or would it always be at the mercy of Washington's bond market, Trump's tariffs, corporate lobbying, and global supply chains? By the end of autumn, the tension had escalated but not resolved. Inflation cooling, yet life still more expensive. Ottawa promising austerity, yet pledging billions in new spending. Mortgages paused, yet suffocating. Conservatives demanding an end to TFWs, liberals insisting on reform. It was the story of a country pulled apart by contradictions, an economy in which every solution birthed a new problem. Every policy contained its opposite. The stage was set for the next act, not just economic battles, but cultural ones. Not just numbers, but identities. And in that storm, Canadians would be forced to decide what kind of country they wanted to be. Canada's contradictions only deepened as the year went on. Inflation headlines promised relief, yet every family knew the grocery store was still a battlefield, where prices inched higher each week and where each receipt felt like a luxury bill. The Bank of Canada's pause on rates did nothing to calm homeowners staring at renewal notices that demanded hundreds more every month. And while the government boasted of restraint, of trimming billions from the public service, it simultaneously pledged billions more for housing projects, defense budgets, and national infrastructure. This was the paradox of Ottawa, a government that spoke the language of austerity while spending like an empire. Mark Carney, the banker turned prime minister, defended the contradictions with carefully chosen words, insisting the next budget would embody both discipline and investment, both fairness and sacrifice. Yet his calm explanations clashed with the anger that was rising across the country, where voices like Pierre Poilievre's thundered with promises of Canadian jobs for Canadian workers. Canada first, Canada always. Poilievre's assault on the temporary foreign worker program landed like a bomb. He recited figures that shocked even his critics. Youth unemployment at 14.6%, the highest in decades outside the pandemic. 1.66 million Canadians out of work in July. Nearly 400,000 stuck in long-term unemployment, searching for jobs for 2 years or more, the worst since 1998. He painted a picture of young Canadians locked out of the labor market while corporations, he claimed, imported cheaper labor from abroad. He thundered that Tim Hortons alone had increased its use of temporary foreign workers by more than 1,100% in just 4 years, that the program had ballooned to over 200,000 permits a year, and that nearly 75% of those jobs were low-wage positions that directly competed with young Canadians and drove down wages. And yet, Poilievre insisted the workers themselves were not villains. They are not the problem, he said. They are being exploited by liberal elites who use them to pad profits and suppress wages. His solution was radical. Scrap the program completely. Stop issuing new visas. Wind down existing permits until none remained. It was a promise of clarity in a world of confusion, a hard edge in a debate clouded by compromise. Carney's answer was cautious, technocratic, almost clinical. He acknowledged immigration levels must fall, from 7% of the population today to 5% in the coming years. He admitted reform was needed, but he defended the program's existence, insisting that businesses, especially in Quebec, told him it was their number 2 issue after tariffs. To him, the program had a role, and abolishing it outright would be reckless. Critics backed him, warning that ending the program would cripple agriculture, shutter small businesses, and devastate rural communities. One farmer bluntly asked how Canada could harvest its crops without migrant labor. Advocates added that linking TFWs to youth unemployment was as bizarre as linking wages in Ontario to the weather in Saskatchewan. Each side hurled absolutes at the other, leaving ordinary Canadians in the crossfire, wondering who to believe while their bills piled up. Meanwhile, the shadow of Washington loomed larger. U.S. Bloomberg hosts warned of yield curve control, a policy where the Federal Reserve would print as much money as necessary to force long-term bond yields down. Jonathan Ferro explained the paradox. Trump wanted lower short-term rates, but that might push long-term rates higher, raising mortgages instead of lowering them. Yield curve control, then, would be the ultimate weapon, unleashing unlimited money printing until the yields bent to the White House's will. For Canadians, it was not an abstract debate. During the pandemic, quantitative easing had driven 5-year mortgage rates to barely 2%. A new round of monetary intervention could again drag Canadian mortgages down, not because of anything Ottawa did, but because Canadian bonds moved in lockstep with U.S. Treasuries. The absurdity was clear. A family in Toronto might pay more or less for their home, not because of the Bank of Canada, not because of Carney's policies, but because of whether the White House decided to bully the Fed into printing trillions. Sovereignty, in this sense, looked like a mirage. At the same time, Ottawa's cuts began to bite. 57,000 public service jobs hung in the balance. Departments braced for 10 to 15% reductions. Economists like John Lester warned that blanket cuts sacrificed efficiency for speed, that a careful program-by-program review would have been wiser. But Carney's government pressed forward. Spending had grown at 7% annually for more than a decade, double the pace of the economy. Something had to give, and the axe fell on workers. And yet, as the cuts rolled out, Ottawa pledged billions more for industrial mega-projects, for defense, for housing on federal land. The contradictions multiplied. Jim Stanford, the labor economist, cut through the noise. We dig it out of the ground and sell it. Then we buy it back as expensive products. If we want sovereignty, we must capture the value here. His words reframed the debate. It wasn't only about inflation, or tariffs, or TFW permits. It was about whether Canada would always be a country that exported raw resources and imported expensive technology, forever trapped as a supplier rather than a builder. But for families, these big-picture debates meant little compared to the envelope in the mailbox. Mortgage broker Ron Butler painted the reality. New home construction in Ontario and BC had cratered to its lowest in decades. Renewals brought only disappointment. Fixed and variable rates remained stubbornly high. Disappointment everywhere, he repeated. For homeowners, it was despair. For renters, it was fear. For young Canadians, it was disillusionment. The Canadian dream, a house, a job, a steady life, was slipping away. And still, the contradictions grew. CTV reporters documented Carney's unscheduled phone call with Trump, where the Prime Minister admitted he had spoken at length with the president about steel, aluminum, copper, and autos.